Mr. Hansen, it's your turn. You can continue.
Thank you very much for that. Let's dig straight in. I have called the outlook for 2024. At least we did that in our first quarter outlook, a year of the metals, for several reasons, which we will discuss in this presentation. But I know that we just been talking about the super cycle. My Bulgarian is not good enough to fully understand what was said, but I'm sure we share the same reasons for looking at this commodity market being in the long-term structural upside. We have been facing some cyclical weaknesses during the last couple of years, but that's following a very strong rally from the low in 2020 up to the peak in 2022. So I will not dwell too deep into some of the reasons, just mention that the world is changing. We are seeing a more fragmented world. Unfortunately, we are seeing geopolitical tensions in several places around the world. And this fragmentation is basically leading to companies reshoring or friendshoring their production back closer to home. We're seeing that within industries pulling manufacturing out of China back to a place like Mexico and US. Part of the reason why the US is doing quite well at this moment in time. The green transformation is ongoing, and it will probably continue almost no matter what the cost is, and that could also be cost intensive and keep a relatively high level of prices in the system. Climate change is one that we are most certainly being exposed to. I think climate change for now is mostly a question about more volatile weather situations, but it does create challenges, and we're going to see some of those, look at some of those a bit later on. And then the duration of a super cycle really it can be quite long, and it really depends on how long it takes for the supply and demand situation to be matched up, because quite often we have demand or supply in inelastic supply, basically takes many years to increase supply. We're seeing that in something like the metals industry right now, that they can take many years for production to increase, and that was something that we will pay attention to. And then we basically think that inflation is going to be higher than the 2% over time, and that will potentially also attract some investment demand into commodities, given their ability to withstand inflationary pressures over time. Let's take a look at just the year-to-date performance of the last 12 months, because it really we've seen some big moves, primarily actually in the soft commodities. Cocoa is a classic example. We'll talk about that in a second. But at the same time, we're also having a bit of a divergence. You can see soft commodities, which are coffee, cocoa, sugar, cotton. They are up. At the same time, we have grains, which is corn, wheat, and soybeans trading down. So again, different weather developments, different performances. We note that we've seen a strong year for uranium. I'll talk a little bit about that later on. And then generally, precious metals recently has had a very strong move to the upside, and that's bringing precious metals up to the second best performing sector over the last 12 months. But let's take a look at tight versus ample supply and what it does to prices. A classic example we're seeing right now, which is very extreme, and we can only say, thank God, this is not happening to wheat prices or something else, because then we would most certainly be talking about a crisis. This is cocoa, so it's a sweet tooth. It's not something that we necessarily have to buy, but the price of it is going up. And as you can see, the prices has spiked now over the last year to prices above $6,000 a ton. The average price in the prior 10 years was lower than $2,000. So what's happening there? Basically, cocoa is produced, around 70% of global cocoa is produced in West Africa, Ivory Coast and Ghana. And over the last couple of years, they've had increasing problems with adverse weather, too wet and then too dry. We have trees that are getting older, so that means they need fertilizers, they need pesticides. But the farmers in Ivory Coast, they are very small, maybe most of them the size of 2 football pitches, so they have no power when it comes to getting the right price for their beans. So they're selling at a much lower price than what the international market is trading at. And that's basically not benefiting the producer, who then has not got the extra revenue to increase production. So what we're seeing right now is the high price is the best cure for high price, because at this point in time, the only thing that can really stabilize the market is through lower demand. simply because supply cannot be increased at this point in time. So it's basically driven by higher prices needs to kill demand, or at least reduce demand. I think we're seeing that already. It's called shrinkflation. Basically, your favorite chocolate bar suddenly is costing the same, but it's smaller. That's the way to keep the sense of something that nothing has changed, but a lot has changed. But it will overall reduce the amount of cocoa needed. And what we're also finding is that the last couple of months, this has not been a speculative-driven rally. This has been producers having to buy back hedges. So what happens is cocoa is bought months before it's been harvested or being produced, and that basically means the buyers of the cocoa, they go into the futures market and hedge their price exposure. And that basically means if suddenly they are not receiving the cocoa they were expecting, then they have to go into the futures market and cover their short position, and that's driving the price even higher than what we've seen recently. Money managers, which are hedge funds, they have been net selling cocoa futures. The red line is producers or hedgers. They've been net buying cocoa in the last many weeks, to the extent that they're now neutral. That should start to take some of the pressure off the price to the upside. And then I talked about the discrepancy between in the agricultural sector, where we have tight versus ample supply. So tight supply in the softs and ample supply in grains. And you can see the year-on-year performance is quite significant. Grain sector down 10%, the soft sector up more than 15%. And I have to mention that the soft index, which is the Bloomberg Commodities Soft Index, does not include cocoa. So obviously with cocoa in the index, it would have been much higher. But it gives you an idea that soft commodities has been trading higher, grains has been trading lower, simply because the northern hemisphere production year was good. The production season on the southern hemisphere, especially for softs, sugar in India and Thailand, cocoa in Ivory Coast, and Robusta coffee in Vietnam, they have all been challenged, and that's driving up prices. And that's why you're seeing this divergence, so very much weather related. Then turning the other direction, natural gas. We're seeing a very, very low price in the US right now. We're trading below $2 a therm. And the market is now so oversupplied that the inventory levels they have are 30% above the 5-year average. This chart does not include the number from today, the middle chart. So the black line is slowing down even more. So the inventory levels are very high. And we are now seeing producers responding. They are cutting production, and that should probably alleviate some of this downward pressure on prices in the coming months. But right now, the low price is needed to cure low prices, simply because demand is relatively inelastic, but in this case, supply is not, and supply can be cut. And that's what we're seeing some of the big producers in the US are doing right now in order to stabilize the market and to ensure the prices doesn't fall further. Similar to what OPEC Plus is doing to the oil price and has been doing now for more than a year. Moving on, just a little bit of a macro picture, because that's clearly also having a significant impact on commodities. Inflation has been softening after that dramatic spike back in 2021 and start of 22. It is coming down not only in the US, but also in Europe. The question is whether it's coming down fast enough for the rate cut cycle to begin. The market has been disappointed this year. You can see on the right-hand side, this is basically the market's betting on number of rate cuts. And you can see the July meeting, which is on July 31st. Right now, the market is betting on roughly around 1.5, 25 basis point rate cut. But in late December, the market was looking for more than 4 cuts by July. And if you look at further out to the end of the year, December 18th, the market is now looking for around 3.5 cuts, and that was closer to 7 cuts just at the start of the year. And this reduction has left the market now more positively in a positive situation, because if we do get some weaker numbers in the US, the market can now price in more rate cuts, and that potentially could give the market some additional support. And I think we're seeing signs of that already. So let's turn to the commodity, which is gold. Gold is up around 20% in the last 12 months, but almost half of that has happened just within the last few weeks. We've really seen quite a strong rally in gold. And it's interesting because it's happening, I would say, almost at the wrong time. Because if you look at what normally dictates the price of gold. That is the dollar. The dollar has strengthened, which is negative for gold. It is yields. Treasury yields have strengthened in the last year. That's negative for gold. Rate cut expectations, as I mentioned, has come down. That is also negative for gold. Investments in gold has continued to come down since 2022, and that's also negative for gold. But gold is still going up, and that is sending a very strong signal, in my opinion. Normally, what we find historically is that gold tends to do well when the US Federal Reserve, pauses and starts cutting rates. I'll just highlight the 3 previous occasions when that happened, and during the subsequent months and quarters, we saw very strong rallies in gold. Right now, gold is breaking higher even before we've seen the first cut, and we may not even see the first cut until June. So what is really going on there? And let's just take a look at some of these graphs just to get a better feel. On the top left, you can see the gold price and the dollar price, which is the Bloomberg Dollar Index. That's basically an index covering 12 different currencies. And I've turned it upside down just to give the right direction. So when the red goes down, it actually means it goes up. But just so that we can see the correlation between them. And that correlation has been good for a while. And just recently, dollar's not really done much. It's actually been strengthening, but gold has been going up. Looking at the one below, that's even more extreme. The real yield in the US, the 10-year real yield, which is the bond yield minus the expected inflation, that real yield has been surging in the last year or so, but gold nevertheless has still been going up. That is not how the gold normally will behave. So, and also just the negative, the ETF holdings, top right, you can see how the total holdings just continue on a weekly basis to be reduced. Why is that happening? What's happening here? I think we're having a divide between the West and the East. The West is basically fund managers. They have been selling out of their gold positions since rates started to move up, because simply if right now the yield on a 12 months US Treasury bill is probably around, well, you can see that here on the middle chart, is around 5%. So if you hold a Treasury bill for 1 year, you get 5%. If you hold gold position for 1 year, you get 0, unless gold goes up 5%. And that headwind is enough for asset managers to reduce their exposure in gold. And they will probably only really start to get involved when rates starts to come down. And that leads me to believe that we may have a second leg higher in gold when rates starts to come down. So what's driving it right now? I think there's several factors. First of all, central banks. For the last 2 years, central banks has been buying more than 1,000 tons of gold. That's record amounts. It's coming from primarily central banks who would like to diversify away from dollars. And it's all happened after the Russia invasion of Ukraine and Russia's reserves being held back by central banks around the world. So Russia cannot access its dollars. And that, I think, has sent a fright through the market. Other central banks say, well, what happens if we don't want to risk that. So we want to diversify. We want to move more of our reserves into gold. And that's an ongoing process. And I think that will continue. It may slow a little bit now that the prices are this high, but I think overall it will still be a strong factor. Geopolitical risks is another factor. The fact that they're discussing taking the $300 billion from the Russian central bank and spend them on rebuilding Ukraine, that I think is that talk has started to surface recently, and I think that's adding another layer of support to gold again from central banks. And then also retail investors in India and especially in China have been very strong buyers recently in China because their stock market is really not doing well, and because the property market is also exposed in the downward direction. That means investors are looking to other investments, and gold is one of them. So I think we're in a multi-year uptrend. This chart goes back all the way to 2007. The breakout we just had right now could potentially see gold move up towards 2,500. We called it 2,300 at the start of the year. As this move has happened already, there is a potential chance that when rates starts to be cut, that we could see it move up potentially even higher. So 2,500 could be a target for gold over the coming months and quarters. If you look at silver, it's underperforming. It needs industrial demand to pick up. It needs industrial metals to pick up. And so far, we're not really seeing that, as we saw that on the slide earlier. And that's why silver is struggling a bit here. So silver needs a strong gold, it needs a weak dollar, and it needs a strong industrial metal market. And right now, we're only having two of those three. And that's why gold has been struggling. But we still see silver outperform gold later on this year and potentially see it back up towards that $30 mark, which is still well below the extreme record we reached back in more than 10 years ago. I think it was in 2012 that we traded almost $50. The upside for precious metals, we believe, is still there. A quick look at the industrial metals, especially copper. Copper is a green transformation metal. We call it the king of green metals. Other calls it Dr. Copper, because Dr. Copper is a good indication of how the global economy is going. In recent years, Dr. Copper has faded a little bit because it's primarily become a focus on China, because so much copper is produced and used in China. But it's also a focus on the economic outlook for China. And right now, the market is somewhat concerned that the 5% growth target that was announced earlier this week by the Chinese government, that it may not be reached, and the more stimulus is needed to support copper. But overall, it's doing reasonably well. It's together with lead, it hasn't fallen that much over the last. This is actually a year-on-year, the table I'm showing in the top right corner there. So it's doing reasonably well, and the underlying reasons for that is the green transformation. It is stronger than expected demand in China. It is the supply side which is being challenged. I highlight some of the reasons there in the top right corner. You can read for yourself. But there has been mining companies are challenged with higher costs. And we're also seeing government intervention basically from one day to the next, cutting away 1.5% of global supply from a big mine in Panama that was shut down by the government last year, just after the government had given the Canadian company, a new 20-year license to produce. So this is also creating some uncertainty. So we believe copper will continue to move higher, or will eventually move higher. It's been sideways now for a year, but we see strong moves in copper, not only because demand is likely to remain robust from the green transformation, but also because of the risk to supply, that it's not going to meet the expected levels that has been priced in. The green transformation has been struggling for the last year, simply because high financing costs is putting a dent on the sector. Perhaps it was probably also over-invested. A lot of investors jumped into the green transformation theme. I did it myself, and I can see the consequence. And right now, the market is looking at medical in pharmaceuticals. They're looking at the AI stocks. They're looking at the technology stocks instead. And that basically means that the market is suffering, especially something like lithium, from oversupply. And that's the reason why we've seen this significant drop in prices over the last year. But again, as you see, copper, aluminium, they're doing reasonably well, and copper miners as well, small up over the last year. Just on the right-hand side, just to give an idea about how much copper is basically used in most applications. So that's why we focus so much on copper when we talk about the green transformation. Let's move on and take a look at crude oil. Really not a great deal to say, which is quite amazing when we consider what's happening in the world right now. We have the Gaza conflict. We have Red Sea being attacked, ships being attacked by Houthi rebels. We have OPEC production cuts. We have China growth concerns. We have Russian sanctions against Russian supplies of fuel, price cap on Russian oil, and so on. But despite of all this, crude oil has actually managed to trade within a relatively narrow range compared with some of the movements we've seen in recent years, due to the success of OPEC to keep production down in order to support prices at a time where we potentially could have seen prices quite a bit lower. Prices have held up, and right now I think it's probably skewed a little bit to the upside. But what we have to remember is that the market is mostly worried about a supply disruption and the market's ability to mitigate a supply disruption. And when OPEC cuts production, that basically means that spare capacity goes up. So if Saudi Arabia cuts by 1 million barrels, that basically means that Saudis spare capacity goes up by 1 million, that means that they can put 1 million back into the market at relatively short notice if that should be needed due to any disruption elsewhere. And that is basically one of the reasons why, even though we have all these concerns about geopolitics, that oil has remained very stable. But it looks fairly certain that there is a floor in Brent crude in between 75 and 70, which will be defended by OPEC. So we call that the price floor. And to the upside right now, 85 is offering equally strong resistance. We've been trying that a couple of times. If we do break, then we'll probably run out of gas again somewhere in the up towards the 90-95 area. But I think, and we're calling it to stay range bound for now, fairly close to $80 in Brent. That has really what it has been doing up until now. When the rate cut starts to be materialized in the US, that may give it some risk appetite, but at the same time, we also we need to see how things develops in China, which is the world's biggest importer of crude oil. Before we move on to some of the educational sector, because just some of the things that I follow myself, just to get a good feel, or try to get a feel for what's happening in the market. What I follow very closely is how speculators, or hedge funds as we call them, how they behave in the market. I used to work for one. I lived in London for 20 years. I worked for a hedge fund for almost 10 years on the trading desk. So I know how they tend to behave. And what they do behave is that they tend to anticipate, accelerate, and amplify price changes that has been set in motion by fundamentals. And that basically means that they will buy into strength and sell into weakness. So they'll buy into a new top and sell into a new low. And that basically means that as long as the market goes up, they'll continue to accumulate long positions. And that does obviously mean that once the technical or the fundamental outlook changes, some major movements can occur in the market. This data is collected every Tuesday and released on every Friday nights. I do this report normally on Mondays, and it just a lot of numbers, but it just gives you the breakdown and how the long position and short positions held by funds, and with that also the net and how that changes compared to last week, and how that the number is relatively to history. I'm only showing part of the table here, but the table is probably twice as big because I take other things into consideration as well. So what we're seeing in this one right now is actually that something like gold in the week to 27th of February, the gold long was only 68,000 contracts. Just a couple of months ago, it was 140,000 contracts. So basically hedge funds, very low positioning in gold. Same time, the crude oil exposure has been going up in the past few weeks. So that is now relatively long. And then we have a massive short position in the grain market, simply because prices has been coming down. And you can see all these red numbers. So short positions in soybeans, corn, and wheat, basically meaning we need to keep an eye on these markets, because if there is a change, as I said, in the technical or the fundamental outlook, it could be a long spell of dryness now in the coming months when we start to plant our seeds in Europe and in the US and Russia. If we run into a dry period and we start to worry about some production, if you go into a period like that with such a big short, then there could be quite a big squeeze to the upside. At the same time, some of the others, we can see a big long now building up in something like cotton, where there's some fundamental support on that. But generally, they do tend to be very active. Hedge funds do not accept losses, so they are very quick to respond to changes, and that's why it's interesting to watch what they're doing, more so than what producers are doing, because they tend to be hedging something, so they tend not to be as price sensitive, unless it's cocoa and suddenly what you have hedged is not going to be delivered. Then obviously you have to close your hedge. That's also the reason why natural gas, when we had the invasion of Ukraine, why natural gas spiked to that ridiculous level, more than 300 euros. A lot of utilities in Europe were looking at in the months ahead for an economic slowdown, even before the invasion started. That basically meant that they had some fixed agreements with Gazprom to receive gas. But as they could see that the demand for that gas was probably not going to be strong enough, they went into the futures market and sold that excess gas into the market through futures market. Gazprom turns up the taps. Suddenly the gas that they had sold, that they were now not going to be delivered, that basically meant they were left with a short position in the gas futures market, which they had to cover, and that helped drive the gas price in Europe to these very, very high levels. So simply because one leg of the trade suddenly disappeared, similar to what we're seeing in the cocoa market right now. As I said, I produce these every week. You can find it on my Twitter accounts where I post the story. I post some of these charts every Sunday, and I publish my report every Monday when I have the data in. Let's just talk a little bit about time is flying, but I think it's important you understand from an investment perspective, because how do we invest in commodities? I like to invest in commodities on a broad basis, simply because the volatility, as you saw in the slide at the start, can be very high. You have one market up more than double, you have another market down a significant amount. But if you have a basket or follow a commodity index of commodities, then obviously you do have a bit of a lower volatility. And that's where it comes into, it really is important to understand what kind of market conditions we have. Is the market in oversupply, like we see in natural gas, or is it in tight supply, like we see in cocoa? That's basically is describing that whether or not it leads to some of these curves. The top one I've shown here is the cocoa forward curve. So the spot price, which now is around 6,700, and then if you go out further out in time, the price tends to be lower, in anticipation of lower prices as supply starts to recover. So we have a market that is what we call in backwardation. If we go the other way and we look at natural gas, you can see over the coming couple of years, gas prices, if you buy gas a year out, you'll have to pay a much higher price than what you pay now. It's simply because expectations of demand to go up and supply to be kept will underpin prices in the future. Why is that important? Well, it is because if you have a position in the futures market, or you have a position in an ETF tracking these commodities, what happens every month when the futures contract expires and it has to be rolled into the next? If the market, as it is in cocoa, is in backwardation, you're selling an expiring contract and buying the next one at a lower price, so you're getting a roll yield. If the market is in contango, you're selling at a lower price and buying the next at a higher price, so you're losing money on that roll. Let's just take a look at what that actually means in terms of performance. I've taken the Bloomberg Commodity Index. It tracks 24 different major commodity futures. I looked in the period up to 2020, where generally most commodities was in contango. There was ample supply being produced, and that basically meant we had these markets in contango. So if you looked at the 5-year performance of the spot price, you would have made 47%. But if you take the roll into account, so the negative impact every month of having to sell low and buy at higher price, basically meant that instead of making 47% on an investment over 5 years, you would only have made 6%. Fast forward now to the last 4 years and a bit, since the start of 2021, we have now got the opposite situation. The spot index trades up around 19%, but if you had an investment in the commodity sector, you actually return on an investment in a commodity ETF tracking the Bloomberg Commodity Index would have made you 35%, as opposed to the 19% the index is indicating. This is the strength of the power of backwardation and contango. So it's important to understand that you can have an ETF position in natural gas, and your gas maybe go up, but you're still losing money, simply because that roll is too expensive to be for the ETF to generate an income. And that's why often investors get very disappointed. They think something is cheap, but sometimes it's cheap for a reason. Let's just take a look at the European gas market. I mentioned earlier how the big spike we had when gas supply was cut was partly driven by not only speculators, but also the futures utilities having to buy back the hedges on gas they suddenly didn't got delivered from Gazprom. The situation in Europe has improved a lot over the last year. The amount of power being generated from turbines, wind turbines and solar, has probably exceeded expectations. And adding to that, a mild winter that we just had, we got ample inventories into the spring. And that basically means that the risk of a spike to the upside is probably fairly limited. A little bit of concern just in the last week or so that there's another refocus on Russian LNG exports to Europe, because while most of the pipelines has been shut, LNG supplies has actually been rising. Russia is sending LNG primarily to Southern Europe, and there's some talk about that being curbed as well. And that potentially will obviously add increased pressure on buying the ability to buy LNG from other countries. But as we can see, gas in the US is cheap and in an abundance. We'll continue to buy a lot of gas in the US. Gas from Norway is also picking up. And overall, as you can see on the top right-hand slide, this is basically where the market is pricing in gas for the next 2 winters. So next winter, the blue line, and the red line, the following winter, all the way out to the 25-26 winter. And that basically means right now you can actually buy your gas and hedge your gas 2 years out at a price of around 32 euros, only a few euros above where we're trading today. So the market is taking a very relaxed look into the future for the gas price. I think I may just have one on uranium as well to finish off. We have seen a very strong interest in uranium in the last year. It has become a very hot investment topic, and it makes sense because we are seeing more and more countries shifting their attention to nuclear power. We will see more demand in the coming decades. We're also seeing concerns that a lot of this uranium is refined and shipped from Russia, and that is a concern, and that is also potentially creating some supply chain bottlenecks. And overall, it's been driving up the price of uranium. But I think we have to remember, first and foremost, this is a very long-term prospect. Uranium demand doesn't just suddenly go up tomorrow. This will take years and a steady increase. And we may see supply struggle to keep up, and it will ensure we see high prices, but we will also see volatility. You can see it's also in the table on the left-hand side below among the uranium trust. What I'm showing here is that's the red line, which is the actual value of this trust, because they only invest in physical uranium. So the actual value of the investment they hold is the red line, and then you have the price of the fund. And you can see just recently we've had a big correction simply because the market ran ahead of itself and became too expensive. And since then the market wants to sell off. And what happens in this period is that the selling pressure from investors basically is stronger than the actual value of the underlying. So just yesterday or the day before, you could buy this fund at a 15% discount relative to the actual value of the uranium they were holding. This does give a buy signal, but it also obviously tells something about a market that's currently somewhat nervous after these strong gains has been partly given back. But our view is that over the coming years, uranium will remain a hot topic. We will see increased profitabilities from the mining companies, and with that also, with that in mind, there will be some interesting investments in terms of finding uranium companies to invest in. I hope my English was not too bad for that you could understand it. I don't know if there's any question that has come in, Clement, but otherwise I'm obviously happy to answer if there's anything come in.
Thank you very much for the valuable information you shared with us. I'm sure that it was interesting and useful for our audience. Mr. Hansen, we really appreciate your participation in the event, and we'll be glad to have you with us again in the near future. Thank you very much again.
Thank you, my pleasure.
Thanks. Дами и господа, предполагам, споделената информация даде подробен отговор върху редица въпроси, но същевременно с това може да е провокирала и някои размисли. Ще се радваме да се свържете с господин Цачев или с мен по удобен за вас начин, да коментираме, да влезем в дълбочина по отношение на темата, която ви представлява интерес. С това бих искал да ви благодаря, че бяхте част от нашето събитие. Надявам се да ви е било интересно и полезно. Напомням ви, че тези дни ще получите запис от събитието с направен превод от наша страна. Този път форматът е малко по-динамичен, по-сбит, но надявам се наистина е бил полезен и интересен. Желая ви лека вечер и попътен вятър в света на инвестициите.